It
Okay.
is.
So what I want to talk about today, as I say, is the economic outlook, because that really, I think, is the context in which housing and mortgage markets operate. So I'm going to be looking specifically at St. Charles County, but of course, as I said, the context is important both locally and nationally. So the two main parts of the talk, I want to talk about the national economy and the context of the recovery that we're having, very disappointing, but it is taking place, and then housing and mortgage conditions. So kind of the summary is that St. Charles County is probably one of the strongest counties in the state of Missouri. And that would be true also if you looked across the Midwest. This is 6.3% unemployment rate in April. The state of Missouri is in the 7s. The national rate is in the 8s. And you don't have to go very far, say in Illinois, before you start to see a lot of double-digit unemployment still lingering. Employment growth has resumed in St. Charles County. I'll show you pictures of all this. This is just the summary. And so the employment level now appears to be higher than it was before the recession in St. Charles County. That is not true in most parts of the country. We are still in a big, big hole relative to where we were before the recession. So that's really a sign of strength. As for the housing market, I think that the St. Charles housing market faces some significant challenges. And nationally, that's an understatement to say we face challenges. I think it's safe to say that the whole housing cycle that we've been through and we're still struggling with is the main story for the economy. That's why this recovery has been so disappointing and why I think it's going to continue to be very disappointing for a long time. And so, that's the bad news for St. Charles County. The good news is that you're on the relatively stronger side of that. So I'll show you all of these items in particular, but home building, as you, I'm sure, are aware, is still very, very depressed relative to where it was before the recession. Home prices are weak, no question. You're starting to get some numbers just in the last few weeks and months that suggest, well, maybe we're at a bottom. And I think that's plausible in a place like St. Charles, maybe even in the St. Louis area, but nationally, I don't think so. I don't think we've found the bottom yet because the inventory problems are so severe, because the recovery is so weak. And as far as home sales, I mean, you all can tell me better, but some signs of life, but still from a very low level compared to what we had before. Mortgage performance in this area, I would characterize as good, not great. It's not as good as it was before the downturn. There are still a lot of people who are struggling, and that also is going to continue. So I won't say a lot about these, but kind of leave you with these questions. I think looking out over the next year, 5 years, 10 years, even beyond that, the real question, and that's why I characterized the challenges that the St. Charles County market faces, I would say in two big challenges. One is just the overall economic conditions. I'll show you some pictures. It might be surprising, some of the things, the longer term trends which kind of combine with this big recession, which suggests that we're not going to see the kind of growth that we saw before. So in other words, you've heard this term, the new normal, and I really think that's true. I think we are looking at a new normal. And so your expectations or your experiences from the 2005, 6, 7 period, maybe a little bit too strong, would say, forget about that. Just put that out of your memory. We're not going back there. And so that's, on the economic side, there's the real question about employment growth and income growth. And a lot of reasons for that, but that's a real big question mark, whether we can generate satisfactory economic growth. And the second one, of course, this is true everywhere. It's true in the Midwest, it's true in St. Charles County. The population's aging, and that makes a big difference, I think, both in terms of, say, job market performance, but also obviously in the types of goods and services that are going to be demanded, and the housing stock. What does an older population want? What does the current, as the population ages, what happens to their, the decision of, say, to move into senior living versus staying in their own home, those sorts of things. Those have always been there, but it's going to be on a larger scale than we've ever seen before. So I'll show you some information about that. Before I go any further, I should mention these are my own views, not necessarily those of anybody else in the St. Louis Fed. Okay. first, now remember I'm going to talk about the national picture first and then zoom in a little bit more on the local situation. So this is a picture of unemployment. And you've seen the numbers, the unemployment numbers, and I'm sure you've had this reaction, well, that doesn't tell the whole story. And that's exactly right. The unemployment rate that we commonly hear about, which was in the most recent number was 8.2%, ticked up a little bit at the national level in May. That includes only those people who are actively seeking work. So people who have stopped looking aren't counted. And we say, well, that doesn't completely capture the difficulties in the job market. So if you include people, what the Bureau of Labor Statistics calls marginally attached workers. So those are people who are not currently seeking work, but when they're asked by the interviewer in these surveys, would you like a job? And the answer is yes. They may be discouraged. I mean, I sometimes get that. I get that reaction exactly from a group of business executives. They said, huh, they must not want to work that much if they're not looking. But you know, the idea is there are, for various reasons, people are discouraged. They may have some family issues they have to take care of, whatever it is. But those are people who are not being served by the job market, and I think of it that way. Another group is people who are working part-time but would prefer full-time work, and the economy is just not good enough for that to happen, or at least that could be one reason for it. So if you include those people, you get, rather than the official unemployment rate, you get this, what I'm calling an extended unemployment rate. It's published every month, it's available, the media just don't publicize it for whatever reason. And this number is 15%. Of course, it's always higher than the officially reported number, but it's especially, the gap has increased. So the number of people in these other categories has increased. The number of discouraged workers or involuntary part-time workers has increased. So that's an indication. These vertical gray bands are the official recession periods, but even in this recovery, it's only very slowly coming down. So that's just a picture of the what you've heard about what a slow, disappointing recovery this has been. In terms of the regional distribution of the weakness, I'll point to three main areas in the country that are very weak. The far west, California still, 3 years into a recovery, California still has 11% unemployment. That's incredible to me. And then you can see the darker colors on this map indicate higher levels of unemployment. And all up and down the west coast, and of course the desert southwest, very high levels of unemployment, above the national average. The second region I would point to is the southeast. Florida, Georgia, the Carolinas are close to double-digit unemployment. And then the third would be the upper Midwest. Now the far west and the southeast are the same story. They have gigantic real estate booms before the bust, of course created a lot of jobs and spin-off activity, and then when housing markets tanked, it went into reverse. And now it's this vicious negative feedback cycle where the very weak markets are hurting the economy, which feeds back, making the housing market even worse. So that's where you're reading all the stories about 50% price declines. The latest number I've seen for the fraction of mortgaged homeowners in Las Vegas that are underwater, 70+%. And as I always say, that's ironic being in a desert, but can you imagine 70% of all everybody in the market with a mortgage is underwater. Florida, and I'll show you more information a little bit later, Florida is a disaster, an absolute disaster. And both because of the nature of the amplitude of this cycle, the up and the down, and the way the foreclosure process works. It's a judicial foreclosure state. It suggests to me it's going to be 5 to 10 years at least before they get through this. So of course that has implications. Florida's a big state, and it has implications on the rest of the economy too. So those are housing, definitely housing-driven cycles. The upper Midwest is a little bit different because that was the industrial part of the country that went into the recession really before anybody else because the auto manufacturers were having a lot of trouble 2005, 2006 period, and then the real estate cycle just got layered on top of that. Most of the Midwest had a more moderate cycle, like here in St. Louis, but there are a few places like Chicago and Minneapolis that had booms and busts that look more like what happened on the coast. So I'll say a little bit more about that, but Chicago is in a world of hurt right now. And again, that's one of those places. And remember, Illinois is a judicial foreclosure state. I think that's a key distinguishing characteristic. Roughly half the country, half the states, are judicial. Missouri is a non-judicial state. Nobody wants to see foreclosures, but if it has to happen, it's better for everyone involved, in my opinion, to to move it through faster. And in the judicial foreclosure states, it just delays it into the, in Florida, for example, it takes 750 days to foreclose. Typically, of course, the person's not paid during that period. Also, the property runs down, it has neighborhood effects. In New York and New Jersey, it takes 1,000 days to foreclose. In Missouri, it's, what, 100, 150. I mean, it can be faster, but it's typically much, much faster. Okay, so there is very much a regional dimension to this. The light states, look at this, in the upper Midwest, they've got no problem at all. They got, in fact, you've read these reports, North Dakota can't find enough workers because they've got an energy boom going on there. And there's also agricultural prices are strong. So we're sort of, as always, you know, we're sort of the intersection of all these different trends. We're sort of on the edge of the industrial part of the country. We're on the edge of the Sun Belt. We're on the edge of the agriculturally dominated part. So we are a cross-section in many respects of what's going on. Still 7.3% unemployment in Missouri. So here's, for the national level, this is the number that probably economists would say this is the single most important data release of the whole calendar, and that's the so-called non-farm payroll report. That came out last Friday, and as you remember, it was a disappointing number. The expectations were 150,000 increase. It came in at like 70, plus the previous months were revised down. And that caused our stock market to fall out of bed. The European markets fell. There was a lot of bad data on that day, in fact, on the whole week. But this is the cumulative amount going back from 1990, so you can see these recession periods. You know, dips down and then it recovers. And the pattern, I don't show you the entire series, but the pattern, of course, is that it takes just a little while, and we end up at a higher level than we were before. Well, that pattern seems to have ended so far. So here's the peak in 1990, here's the peak in 2007, and here's where we are right now. This is as of last Friday. We are far below the peak even of 2007. And at this pace, it will take another 5 years to get back to the previous peak. We've never seen anything like this before, that has had such a deep recession followed by such a slow recovery. So that's why there's so much discussion, so much angst about what's going on with the economy nationally. So one way to just kind of think about, and I just want to say a little bit about what the Fed is thinking about this. One way to think about how the economy grows over time is that it's kind of following a trend. It's what the economists call the potential growth. I always use the analogy, it's like your kids. You sort of have these expectations for what they can achieve. You know, they may fall off the path a little bit, but you think, well, they'll pick themselves up, and next time they'll do better. And this is the same sort of thing. If you draw this line through employment, you think, you know, we get knocked off the path, when we get back to it, we get knocked off the path. Well, already this last recession was disappointing. I think part of that was because the boom in the 90s was so over the top, really. So, okay, maybe you have to reduce your expectations of potential. Maybe the economy can only grow like this from the 2000 to 2007 peak. But you can see we're not even living up to that potential. So it's like, you know, you keep lowering your expectations is what's kind of happening. We had expected, you know, that we would get back to there much more quickly. But as it is, it looks like we'll only get back to this trend line by 2018 or so. So if the recession began in 2007, and it takes us to 2018 to get back to where we should be, that's what you've heard a lot of people talk about, a lost decade. We are halfway through, this is my opinion, we are halfway through a lost decade of substantial underperformance in the national economy. And as I said before, a lot of this relates back to housing, because we had such a boom before, we've got so many adjustment problems today. And you know, I never tire of saying this, we in the Midwest are so fortunate that we did not have the crazy booms that you saw in the Southwest and Florida. If anybody here was jealous back in 2005, I wish my market was appreciating at 30% a year. Oh man, that is, you know, that's a recipe for disaster. And our more moderate cycle is one of the best things that we have going for us. Here's the unemployment rate now at the county, zooming in a little bit locally. And again, the darker the color, the higher the unemployment rate. So these very dark, these are double-digit unemployment counties. We have a few of them. This is Washington County, I think. But look at St. Charles County. That's the lightest color, and what I'm calling roughly, this is the strongest economy in a 50-mile radius. Of the whole St. Louis region, this has the lowest unemployment rate. And you can also see Illinois is generally much more distressed. And particularly if you look at, say, counties directly on opposite sides of the river, there's no plausible reason why those economies are that different, except things like, well, obviously the political system, the tax environment, and now the foreclosure situation, which bottles up the problems in these markets and feeds back on the economy. So it's like a case study here, Missouri versus Illinois, in how those different legal environments, for example, affect the economy. All right, so there's the analog for that non-farm payroll number for St. Charles County. And so this is a very unusual picture. There are not very many places in the country that can say that their employment is higher than it was before the downturn. Here's comparing to some other St. Louis area counties, and in this case now I put everybody back on a common starting point of 100 in 2000. You can see the two recessions in this decade. St. Charles, of course, was growing much faster before the recession, and it has, after this recession, has done better. The reason for the choppiness there is that there's a seasonal cycle, which it's very difficult to adjust that at the local level. So this just shows the actual count, not taking into account that there are predictable seasonal patterns. Okay, Jefferson County, just to the south of St. Louis County, of course, has not really picked up much. St. Louis County hasn't really picked up much. And St. Louis cities, you always have to handle those data with some caution because there are real questions about counting. Even, they have real difficulties with the census every 10 years, disputing about whether those numbers are correct. So that's partly what's going on here. At the time of the census, there's always a big gap in trying to catch up with what's reality. But the reality is St. Louis City's not creating very many jobs either. In terms of home building, first some larger metro areas in the Midwest. So these are the actual number of private building permits. This is a logarithmic scale, so I can put them all in the same chart, and it shows different percentage changes more readily. So you can see, for example, Chicago, huge decline from, if you read the scale here, close to 15,000. These are now quarterly. So 15,000 a quarter down to about 2,000 a quarter. That's a big decline. And it has basically stayed very low since then. St. Louis, a big decline, but not as large, not much recovery. Kansas City, same situation. Springfield. I mean, it's everywhere. And that's one of the surprising things about this cycle too, is even though we didn't have the crazy boom, certainly with house prices, we actually had a lot of home building, particularly when you think about relatively slow population growth in our areas. So I think that's one reason why our home building also has been so depressed, because we had plenty of inventory. And so that's, I would say, in fact, I spoke to home builders yesterday, don't expect that to change. I don't think we're going to see any recovery in home building for quite some time. Because, for example, the builders are worried about distressed properties coming back into the market, creating competition for new homes. If you take, here's, I guess these are the same cities, and put them back on a common starting point so you can compare percentage changes. Here's Chicago, 90% decline in home building activity from 2005 to 2009. Kansas City, almost the same. It's bounced up a little bit. St. Louis and Springfield, Missouri, more like a 70% decline. So, as I say, I think of all of the real estate-related sectors, home building has been hit the hardest. Now, of course, they also had maybe the biggest boom. They had the largest increase in profitability beforehand. At this meeting yesterday, what I heard someone say is about 2/3 of all the builders are gone who were there in 2005.
More than that, yeah, like 90%.
Many of them, might still be hanging on by their fingernails, but they're not doing much building right now. Although, everybody has a story about, well, I've got some some signs of life. Here are some other counties. So I want to, within Missouri, this is private home building. These are now, actually these are annual. This is mislabeled. So these are annual numbers. Okay, here's St. Charles County is in the dark red. So down about almost 70% home building activity to 2009. A bit of a recovery 2010, and then a big decline in 2011. So that, this is an extended cycle. We just haven't come out of the recession cleanly. Greene County is Springfield, Missouri. Similar, St. Louis County, and Jackson County, Kansas City, which had a much bigger, and that's generally been the case. The Kansas City area has had a stronger economy before the recession and a bigger decline than St. Louis area. And I think that's partly real estate related, and it kind of shows here that there was a bigger cycle in real estate markets in the Kansas City area than there was in St. Louis. Okay, this is, again, private building permits, and these are the absolute numbers. So I wanted to show you, you probably knew this already, that St. Charles County is the single leading home building county in the state. And that has been true most of the last couple of years, and in the previous boom, Jackson County, Kansas City County, was a little bit higher. But it's the combination, I think, of what I'm going to talk more about, the resilience of St. Charles County's economy and the fact that the cycle wasn't quite so over the top, that there's been, now St. Charles County has actually moved ahead. Yes?
Well, I'm confused. The previous one showed that we're like on a downward spiral for building permits issued, but the next screen shows that we're...
Well, this is quarterly data. That's one source of confusion. This is annual. This is quarterly. So you can see this bounce up here. That's first quarter of 2012. So the bad 2011 that was shown before is this section. And that's one reason to show the annual data is it kind of smooths it out a little bit more. But this is the most recent quarterly number. On either scale, St. Charles County and Jackson County have been among the top building counties in the state. Okay, this Tracy, you sent me this information, and this is home prices. These are resales, or median sale prices. So this is from 1998 to 2011, and the blue line is St. Charles. So pretty good increase over the boom period. Peaked at 188 in, what is that, 2006 and 7. And then, following this downward momentum that you see, the green is the national, and the red is St. Louis. These two are from a different source. These are from Zillow, but the patterns are very similar. The national home market, home prices peaked in 2006, according to most of the major indexes. We peaked a little bit later, 2007, but we have more or less followed the same cycle down. There are a few areas that look like they may be hitting bottom. I think Phoenix, but who knows? There's so much volatility in that market, so much inventory that still has to come through. It's hard to know if that's really a bottom yet. This is the volume of sales. Again, Tracy shared this information. This shows St. Charles County, and then the red is the nation as a whole. And what I've done is take the national data and adjust it, transform it so that it's equal to this number for St. Charles County back in 2000. So you can then see on a relative basis whether St. Charles has been above or below the national trends. And so you'd have to say from 2000 to 2005, St. Charles County was slightly higher level of sales, or the increase was a little bit greater. But then again, the trend has been very, very similar. So it's almost a mirror image of the pattern of the volume of sales. So a little bit of a tick up in 2011, but not much compared to the decline. Okay, now I want to show you mortgage conditions. First, I'll start at the national level. These are color-coded, sometimes called a heat map. The dark green has the very lowest levels of delinquency. So that's less than 5% of the mortgages in the county are in some stage of delinquency or foreclosure. So back in March of 2006, and that's exactly at the peak according to the National House Price Indexes, most of the country is in this very dark green color. So that's almost no distress, which of course is not too surprising because when house prices are rising, it's pretty tough to default on a mortgage. You can either refinance it or you can sell it in a very good market. The only area that looked really weak was down here, and this is the footprint of Hurricane Katrina that hit in late 2005, and that was a very economically weak region anyway, the Mississippi Delta particularly, and then that natural disaster layered on top of it made a big imprint. Here's, now I'll go through year by year and just show you how this changed. So this is March of 2007. Here's March of 2008. Now as it now appears, looking back, we already had entered recession at the very end of 2007. This was the month, remember, Bear Stearns was taken over by JP Morgan. We knew that there were problems. The banks were reporting lots of losses, but we still didn't think it was going to be too serious. So that was the general consensus. Okay, that's March 2008. There's a year later, March 2009. It's now clear that we've got a big problem. So the levels of delinquencies have more or less gone up everywhere, except, again, in these boom states in the Dakotas, maybe. This is after the meltdown on Wall Street in September of 2008. This is after TARP. This is after the election and the new economic stimulus package. And in fact, March of 2009 was the very lowest point for the stock market. It started to recover after that. For the economy as a whole, we think probably about June 2009 was the low point before things really started to turn up. Okay, now, what I want to point out is you would expect, perhaps, one might expect, that, okay, the stock market, the economy is bottoming out at this point. You'd start to see some improvement. And I'm going to show you that it didn't happen. So this is March of 2009. There's March of 2010. It's actually worse. So the economy has been 9 months into recovery. Mortgage conditions have actually gotten much worse. Here's March of 2011. Not much change. There's March of 2012. There's been very little change over the last 3 years. And this, of course, doesn't even take into account that all those mortgages that have been foreclosed or short sales or whatever, distress, those are gone. These are the currently in-place mortgages. And so this is, the point I made before. This is a very different cycle because it's so much related to the housing cycle. There's the delinquency issue itself, how foreclosures are feeding back on markets, and something that we're working a lot now at St. Louis Fed on is how do you think about the balance sheets of households and how they're reacting to that? Well, a lot of people are trying to, even if they're not losing their house, they're trying to reduce their debt. They're trying to save more, and I think that's one reason why spending hasn't been growing very fast. And then stands to reason, businesses aren't hiring very much, they're not investing very much because they say, why should we? We don't think consumers are going to spend a lot more. Or, I sometimes say they think there's no gas in the tank. So why should we ramp up expecting a vigorous recovery if people are still kind of licking their wounds, trying to recover from this big cycle? So you can see Florida is just a total mess, contrasted with the far west, which if you go back, let me go back to, so here's Southern California, the inland parts of California, Nevada, pretty bad in 2009 and 10, but then they got better. And that's, I think, in large part because the foreclosures moved through faster. California's a non-judicial state. In Florida, they can't move, so those problems are bottled up. So now I'm going to look at the local area. These are now at the zip code level. Same story as before. The dark green are very, very low levels of delinquency. Yellow is intermediate, and red is very high level. So back in March of 2005, I backed up one more year. Look at St. Charles County. Pristine, with a small exception there at the very eastern edge. March of 2006, still very, very good. March of 2007. Notice that in the St. Louis region, though, you are starting to see some pretty stark indications of distress. This is March of 2007. You're already getting 10, 15% delinquencies. Those are North St. Louis County, North St. Louis City. Those are regions where there was a lot of very aggressive, I would say predatory lending going on. So there were defaults happening even before the housing market turned. And it's so like a telltale sign that there was predatory lending going on in sometimes weaker communities, communities of color, and you saw those problems already peeking their ugly heads before the downturn. Here's March of 2008, March of 2009, March of 2010, here's 11, and 12. It hasn't really changed much in the last 3 years. You still have, within our region, and in fact, the type here obscures it a little bit, but you have within just a few miles of each other, extremely low and extremely high levels of distress. So there's disparity even within our region. St. Charles County, as I said, still looks relatively good. That's why I call it good, not great. It's still higher levels of distress than before, but compared to the region as a whole, or the country as a whole, it looks a lot better. I mentioned before the distinction between judicial foreclosure states and non-judicial. Here are the judicial states, the ones marked with a J. And I haven't done this formally, but my conjecture was that if you tried to control for economic conditions and then differentiate between judicial and non-judicial, it would be like night and day in terms of the mortgage problems. That judicial foreclosure process is slowing the recoveries. And of course, these are some pretty important states. For example, Illinois, Florida, up through the Carolinas, the Northeast. And so this is one reason why the national recovery is going to be so much slower than we would like. Okay, now I want to just show you one picture on both sides of the river. This is April of 2012. So this is the most recent information we have. And if you kind of follow the Mississippi River cutting down across the map, my impression is that it's just a little worse on the east side of the river than it is on the west side of the river. So I think that is related to that bottling up the problems. Another thing to point out, of course, is that this green, this is sort of the 40 corridor going out from downtown. This is a pristine little island in a sea of distress. And I talked to a group of realtors down in West St. Louis County and said, you may not understand, you may not realize this, but this is not reality where you live and work. The rest of the world is having a real hard time getting through this. Okay, now let's look at employment. So these are the absolute numbers of people employed. Here's St. Charles County, strong growth over a long period of time, just roughly doubling between 1985 and 2005, whereas St. Louis County has been basically flat for the last 25, 30 years. St. Louis City, in fact, has been in long-term decline. Jefferson County growth really has stopped over the last 10 to 15 years. So St. Charles County in this regard, too, is unusual. It's one of the few parts of the region that has shown growth even into the decade of the 2000s and probably beyond. But that growth is slowing. These are the growth rates, annual growth rates. If you take a 5-year moving average to smooth out, there's a lot of volatility in the numbers at shorter frequencies. So this is, the line here is the whole St. Louis metro area, excluding St. Charles County. So you can see going back to 2000, there's been essentially zero or negative growth on this long-term measure in the rest of the region. So we are a very slow-growing region overall. Here's St. Charles County alone, and it's been positive, but this most recent number is about zero. There's been about zero employment growth here over the last 5 years. And the question that I pose is, what happens to this in the next few years? Is it going to continue to go down? Or is it going to plateau at zero? Or somehow pick up? Don't know for sure. Here's one way you would try to approach this question as well. What's happening to the population? Here are populations by county. St. Louis County, as you know, has been basically flat for several decades, tipping above and below 1 million residents. St. Louis City has been in decline since the 1950s. Some signs it may have kind of flattened out. in the last few years. Here's Jefferson County, which, similar to the employment chart, has kind of slowed its growth. And there's St. Charles County, the red, which just passed St. Louis City. So now St. Charles County is the second largest municipality or county in the region. But again, you can see this is a logarithmic chart, so the slope of the line represents the percentage change, the growth rate. So as it gets flatter, that's saying that the growth rate is slowing. You can kind of see that pattern in St. Charles County. So what are we looking at going forward? Well, one of the clear trends that we see everywhere is the population is aging. So this is the share of the population aged 65 or older. This is from 1970 up to 2010. Those are actual numbers. And then there are projections available for the state. I haven't seen them for the counties, but we're going to be somewhat related to that. So St. Louis County has an older population, has had for a long time. But see that St. Charles County, like everywhere, is aging. And then this projection for Missouri is that that will continue. This goes out over the next 2 decades. So, for example, Missouri's population will go from 13% to 20% of the population will be 65 or older. So you would have to expect that the St. Louis and St. Charles County are going to be something similar to that. Maybe something like that, maybe something like that. So maybe you're looking at 15, 17% of the population being in that age group by 2030. Now, of course, people are probably going to work a little bit longer. People are in better health. And so that changes what we think of as the retirement break point between ages. So what does this mean? You've got slowing employment growth. You've got a very weak national context. And we know we've got an aging population. So those are the ingredients, I think, in this sort of the challenges that the housing market has to face. Admittedly, from a strong starting point. St. Charles County having, as I said, the best economy in the region. Here are, I think, these are Tracy's numbers. Pending home sales. I just went back and tried to look 6 months through April of each year to give you kind of a snapshot. There's some weather fluctuations in there, so try to smooth that out a little bit. Here's 2007, 8, 9, 10, 11, 12. So there has been an uptick in the 6 months through April. But we've seen this before. It looked like maybe we were coming out of this in 2010, and this was probably related to the first-time homebuyer tax credit. But there was also the feeling like maybe the economy was really lifting at that point, and it sort of fell back to earth. And so that's kind of where we are. That's why I think there's so much volatility in financial markets. People are not sure, is this one for real, or are we going to fall back again? Really, like each of the previous 2 years, we had a disappointing summer. So I'll sum it up, and then maybe you have some comments or questions, observations. The context is the national recovery is very weak. The regional economy is not only suffering from that, but it's just a slow growth region to begin with. So it's in that context where the relative strength of St. Charles is going to have some headwinds fighting against that. Unemployment rate is good, relatively good, although who would have thought 5 years ago 6.3% unemployment would be something to jump up and down about. Employment growth does appear to be positive again in St. Charles County, but as I said before, the challenges include, in particular, I would say, this overarching economic uncertainty, and as you look out a few years, of course, from 1 year to the next, maybe it's not so dramatic, but the cumulative effect is going to be pretty significant of the changing age, for example, the changing distribution of ages, and so what that means for the housing stock. So why don't I stop there, and if there are questions, comments?
All the way in the back.
All right, with the new construction, the past couple of years, the pricing has dropped, as we all know. What is the average? You carry those stats for new construction in the county? What it used to
You
be,
mean
what
the
the new norm is?
Well, you mean I didn't have that picture. Was that the one you wanted to ask about, the number of building permits?
Well, no, the price range of the housing. Price
The
construction.
new homes?
Exactly.
I don't have that independently. Maybe somebody knows that. But I did hear from the home builders yesterday that they, I think if I remember it correctly, the guy said, we used to think $30,000 premium on a new house or discount on an existing house. Now it's more like 70. It's because there's so much distress or near distress inventory. And the other point, relevant point, is that this builder thought that there was a strong trend towards smaller houses. They're building smaller houses. Yes.
What do you think would happen if Missouri became a right to work state?
Okay, question was if Missouri became a right to work state. Well, let me broaden that more generally. I sometimes say that what Missouri should do, or what our leaders should do, is voluntarily resign from the Rust Belt and join the Sun Belt. And I think things like regulation, I mean, people didn't think of this before, but the judicial foreclosure status, that's part of the legal environment, the tax environment. How difficult is it to start a business? There was a discussion among the home builders about, don't want to offend anyone, but how do I work with union carpenters? How do I negotiate? And there are all sorts of things that have to do with the business climate. So I guess I would broaden this question to say, is it plausible that Missouri can create a business climate more like what you see in the West and the South than in the North and the East? And certainly it is plausible. And we have, I guess, didn't show it explicitly, but one of my theories about why the Kansas City region has done better than the St. Louis region over the last 10, 20 years is because Kansas City shares a border with Kansas, and we share a border with Illinois. And I think there's a difference in the business climate in Illinois versus the business climate in Kansas. And to the extent that Missouri can, I mean, we see the challenges. We don't have the underlying growth drivers that are just going to naturally create lots of jobs. We're going to have to work at it and make it a good place to do business for attracting outside, but also creating homegrown employment. So, I'm not answering your question exactly, but in terms of, yes, it makes a difference what the business climate is. Part of it is political, part of it is people's attitudes. I think we have more of a, we have a better attitude about things than, say, if you go to, I'm from Illinois originally, my wife's from the Chicago area, and it's just a different attitude. I think we are more open to new things, to growth, and I think that will be a positive. Yes?
Just follow this general theory, but anyway, prior to the peak in 2006, population across the country was growing at about 3 million a year.
1% a year, yeah.
Okay, and due to immigration, births, people living longer, and they said there was an average of 1 or 3 per household, so you needed 1 million new homes every year. And if you have 2/3 of the builders non-existent, and rents are going up, everything because the flight to rental, but isn't there at some point out there a shortage of housing where you can't get the builders in line, and you have all this deferred growth, need for 1 million of units every year? So when does that all of a sudden do a V shape instead of the sloppy U that we're in? Right.
So the question was about, isn't there a time when we will need a lot more new housing? I think that's right. If you ask for a time, I'll give you kind of off the top of my head, 5 years. I think we've probably we've got enough overhang and enough distressed inventory. And you started to allude to this. This is something that, of course, a lot of people are wondering about or worrying about, is what do young people think about home ownership? And there's the question of, what do they think about it? We have a 24-year-old daughter. She's got no intention of buying a house anytime soon. And also, are they going to be able to? And that's related to mortgage qualifications. But I actually think that's maybe not a bad thing if people do save up a little bit more to get into their first house. But I think those issues, the transitions toward maybe a new attitude toward homeownership among young people. And you mentioned immigration too. That's another one of these this recession was so significant that even immigration is way down. The rate of new household formation is way down. The birth rate is down. You have to go back to the Great Depression to see this kind of fundamental impact on lots of different parts of society. Some people would argue our political climate today is partly related to this economic turmoil. And so, yeah. So, in terms of when will we come to, I agree with you. We are going to continue to grow over time, but there are these other things that are going on that I think make it difficult to know, but also be confident that that time you're talking about will come very soon.
That's got to put an awful lot of upward pressure on rents in the interim.
Right, and I think if you look, I didn't show it, but if you look at the split between single-family home building and multifamily home building, it is definitely shifted. And it's partly because if you go back, multifamily home building was very, very low. And it was all single-family during the boom. And so, like so many things, we sort of go from one extreme to another. We were building almost only single-family before. Now it's heavily dominated by multifamily. So it just makes it hard to figure out, when is this a permanent shift or is it just a temporary? Hard to figure. Yes?
I would assume you guys probably have some sort of statistics that would show, for instance, we are in election year.
Right.
And that, I think, definitely plays into, are people going to go, do I buy now? Do I
Right.
not buy now? What do I do? Because I don't know what's going to happen after November. Is it
Right.
going to get better? Or are we going to keep trending down
Right.
to hell?
Yeah, the political uncertainty, no question. Some people might say, well, no matter who gets elected, it's not much will get done. I don't know. I would say that there is, in fact, our president, Jim Bullard, has talked about this a little bit, the uncertainty that the Fed is creating with interest rates. So in a sense, that's the way I would characterize it. The Fed is committed to keeping short-term rates very low, essentially zero, through the end of 2014. And markets apparently believe that because longer-term rates are very low. And so you might argue, and this is kind of the Fed's argument, well, this is sort of reducing the fear factor, reducing the uncertainty because people know rates are going to stay low for a little while. That's true, but on the other hand, it creates a lot of uncertainty when you look beyond that. What happens to rates after 2014? Or some people are, President Jim Bullard thinks we won't even get that far. Is it going to be a very rapid increase in interest rates? So in other words, I think there's no, as economists would say, there's no free lunch. You can't create certainty when the world is just inherently so uncertain. And I think what the Fed has done is kind of push that off a little bit, but it hasn't eliminated it. So in terms of the effect of very low mortgage rates on home buying, you probably have impressions about this. On the one hand, yes, this is the best, most affordable mortgage rate environment we've seen, but it's harder to qualify. And because of this thing I'm talking about with the Fed, there's no rush.
Right.
Rates aren't going up. Fed told us they're not going up. So I'm going to sit on the fence a little longer. So I think that's also kind of a disadvantage or a weakness of the policy that we're carrying out right now. Yes.
Do you have any prognosis for the North County recovery and what that might look like?
So you're talking about the distressed areas.
Just pray.
Yeah, I mean, that's very much related to, I mentioned this project, what we're calling the Household Financial Stability Project, where we are trying to look at different parts of the population. I would have to say, we at the Fed, all of the people, the professionals involved in anything to do with housing, mortgage, I don't think we served the population well. I don't think that we were fair to, setting up people for failure in some cases, taking advantage of people. As I said, some predatory practices that were going on. And I think there's a lot of damage that was done in everywhere, but particularly in some communities, and that's going to take a very long time to recover from. Yes?
I know there's a lot of people here that want to be positive about this, and I wish you'd speak to Dr. Lawrence Yoon and kind of straighten him out, because I think you're much more realistic than what he presents. But I'm curious, where are these new buyers going to come from? Because those that have saved money, we got just a little bit of an uptick in mortgage rates and everybody jumped out there. Okay, those folks are gone now. So you have to have a 2-year job employment history. If you switch jobs and it's not in the same industry, you're disqualified. You have, like you said, your daughter. I have the same way. I have kids, and if they don't want to move out, they're not going to move out, and we're not going to kick them out. So you have an extended family, which is historically we used to have. And you used to have many households in one house. So it's not a big, it's a different change, but it's something we've already done. Like you said, you have an aging population, and as we age, some of us are going to die, so you're going to have more housing stock. And you're also going to probably have some young people that move in with grandparents to help them out. So where are those new buyers going to come from that everybody wants to be so positive about here in the next couple of years?
Yeah, I think it's your question, where are the home buyers going to come from? I think the rule of thumb, that we need 1 million new housing units a year or something like that, or whatever, is 1.2. That may be too high because of some of the trends that you're talking about. And that's really all I will say, is that I think over the next few years, that's going to be too high. But even looking out 5 or 10 years, yeah, it's not easy to gauge that.
Okay, we've run a couple minutes over what's your name?
Daryl.
Daryl, to address you, Daryl, everybody who knows me in this room, I'm the ultimate optimist. So the positive things that I gained from what Dr. Emmons presented today, first of all, let me say that the numbers that I sent you actually come from the SCCAR PR committee. I encourage each and every one of you to come to a PR committee meeting. It's always after the board meeting. I think it's the second or third Wednesday of the month. The statistical reports that are available to you guys on SCCAR's website are produced by Cindy Fox. And I tell you what, if I was a realtor, I would not go on a listing appointment or a buyer's appointment without those stats. And that's where that data came from. So Cindy, we cannot thank her enough. So you guys should really search for that information, because it's fabulous. The positive, positive things that I took away, even from watching the maps and how things were progressing over the last 5 years, is that St. Charles is protected compared to other counties in our area. If I was a realtor, I'd be pretty proud to be, and as a lender, I'm proud to be in St. Charles, because it's the place to live. It's our our unemployment is one of the best in the state. Okay, our unemployment rate. We've got growth. Home building, you showed, is the most robust in the state, right? More housing permits than anywhere else. I think that St. Charles versus St. Louis in the foreclosure arena, we're not going to have as much inventory to get through. Let me see. And the other thing that I would say, just as a state, is that thank God we're not a judicial state. Because even though the foreclosures are coming, and you guys know who the REO companies are, let's just flush them and get them through as quickly as possible. So those are the positive things that I saw. St. Charles, we are protected, other than the infamous 40 corridor in the St. Louis market, and they're just, like you said, living in peace and harmony. But that's not reality. So that's it. But I want to thank Dr. Emmons for coming. This information is a reality check, that we can share with our clients. I want to give Court, our president, the floor for some closing remarks, and thank you all for coming. Cornerstone Mortgage is happy to have you here, okay?
Thanks, Tracy.
Thank you.
I'll be really quick as well. Tracy, I want to thank you and Cornerstone for getting Dr. Emmons here. Thank you so much for being here. I think this is excellent information for us to have for our clients, and it's probably not what we all wanted to hear, but we all kind of knew that was the news. But like Tracy did, take the positive things out of it and try to use those to be positive, and I think great things will start coming from that. I want to let you guys know this will be on SlideShare on the SCCAR website, the actual slides that he presented, and you're okay with sharing that information. And also it's recorded, so you can find that also on the SCCAR website. Please consider sharing this with your associates in your office. Get the word out. Let people know we want to be the experts when we're sitting down at the table with our clients. Let them know that we know what's going on and where things are going. I think that's all I have. And to address your concern, how to get the kids out of the house, he started charging me rent when I was 18. bought my house at 19 years old because I said, why would I be paying him rent? Thank you all for being here today. Have a good rest of your day.